bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the June 17th, 2025 episode. My guest this week is my partner, Lance Smith. He works out of Novogradac's Petaluma, California office. And Lance is one of Novogradac's leading experts when it comes to nonprofit developers of affordable housing. Now, our regular audience will note that Lance was on this episode pretty recently, just over a month and a half ago on May 6th, 2025. In that episode, Lance and I discussed why a for-profit developer might want to joint venture with a nonprofit developer. And we noted there are a lot of reasons, one of which is property tax abatement or potential reduction by having a nonprofit joint venture partner. There's also the ability to compete for the 10% set aside of allocated local tax credits and many other reasons. And I would encourage our listeners or viewers to go back and rewatch or listen to that episode. And in that episode, in my introduction, I suggested that it might make sense to have Lance come back on the podcast to look at the relationship from the inverse. And that's to examine reasons why a nonprofit developer would want to joint venture with a for-profit developer. And that's what Lance is back here on this episode to discuss. What we will do is we'll cover a similar approach to this podcast like we did on the May 5th episode. Lance first will discuss some of the advantages and opportunities to nonprofits by joint venturing with a for-profit developer. We're also going to revisit two key tax risks for the nonprofit developer and/or the partnership and the investors in the joint venture. And then we'll also discuss the challenges that come with a partnership by a nonprofit with a for-profit. Lance and I have a lot we want to discuss. So if you're ready, let's get started. Lance, welcome back to Tax Credit Tuesday.
Thanks.
This is your third appearance on Tax Credit Tuesday, over the last 2 months. Don't worry, I won't force you to come back every month. But for members of the audience who didn't catch last month's episode or your first appearance over a year ago, please describe the services that you provide to your Novogradac clients.
Like I say, I enjoy working with a variety of nonprofit organizations, but particularly nonprofit developers. But I also get to work with for-profit developers as well, which is giving me a good opportunity to view the development process from both the directions. My services include audit and tax work for lower tier entities for these developers, as well as consolidated audits that include compliance with uniform guidance, as well as HUD and state compliance requirements. I've been around long enough to work through many of the developments from the application process and the construction all the way through the operations to the final liquidation of the partnership and witness what I refer to the afterlife of the development through resyndication, refinancing, or just simply exiting the limited partner.
Right.
I believe.
Sorry to interrupt. Keep going.
I should say, I believe a well-prepared set of financial statements can offer a great story. So I enjoy working on that.
Sorry for interrupting there. Thank
No
you
problem.
for the overview, and I'll include your contact information in the show notes for anyone who wants to reach out to you. So as I mentioned in the introduction, the last episode, you talked about reasons why for-profits might want to be joint venturing with nonprofits. And today we're talking more about nonprofits joint venturing with for-profits and the reasons why a nonprofit would want to. But in preparing for the podcast, you and I kind of noted that if I think of, like a box with 4 quadrants, I can think of a nonprofit joint venture with a for-profit, but I can think of there being 2 types of nonprofits, a large nonprofit or a smaller nonprofit. So if on one axis I had nonprofits, large and small, and the other axis I had for-profits, large and small, you can kind of get a sense of, when would a large nonprofit want to joint venture with a small or large for-profit, and when would a small nonprofit want to joint venture with a small or large for-profit, if ever? So in that sense of sort of four quadrants here where you have small for-profit, small nonprofit, large for-profit, large nonprofit, and then a large and small of each. Describe what your experience shows in terms of which types of joint ventures you generally have when it's a nonprofit joint venturing with a for-profit.
Okay. Yeah. So we're on this quadrant, where are we finding all of these entities, these relationships, or they're all clustered in one quadrant versus the other? But I think let's first make a good distinction between large nonprofit organization and a small one. First, you may have a large nonprofit, but for our purposes, it may still be considered small because they don't have the team or skills or understanding of working in affordable housing specific to what we're looking at. So they may still be new developers. So that I would kind of codify this large entity as still small for our purposes. So in our quadrants here, so first step down the first quadrant, we've got the small nonprofit, small for-profit. I don't know as I'm probably going to see many entities in that because neither of them have much to leverage off of the other. So it'd be more meaningful for them to move to one of the other quadrants. So let's go to the second quadrant, small nonprofit versus a large nonprofit. I think these are much more common for reasons we're going to get into a little bit. We'll save that for a moment. Then we have our large nonprofit, small nonprofit, or large nonprofit, small for-profit. I don't know if these are as common, but given the right circumstances, it could certainly be an opportunity for that. But this final quadrant then is our large nonprofit, large for-profit. And I think these are still common, but they're going to be for different reasons than the small nonprofit, large for-profit relationships.
So thank you for that, Lance. Now, when we think of the four types of relationships, let's now focus on the advantages to nonprofits of teaming with a for-profit developer. And as you noted, a nonprofit developer might team with another nonprofit, but for purposes of this, let's think about nonprofit teaming with a for-profit developer. What are some of the key reasons why a nonprofit would be looking to joint venture with a for-profit?
Yeah. So I look at it more of the attractions that a for-profit is going to have. What are the characteristics this nonprofit is going to look for? And the first one is I identify as technical expertise, that they're going to have a lot more knowledgeable people, know how the developments are going to operate. They'll probably have larger staffing as well. That's the advantage of a larger for-profit entity. They're more established. They've got a network of working professionals, architects, engineers, even accountants, attorneys, and various other players in the industry. They've already got that network developed. This for-profit entity is also likely to have a working capital. Again, an attraction for one is how they would have that working capital and access to professional funding. And I consider this pretty important in that it can be a long ways from completing the construction with a lot of pre-development costs being incurred along the way. Specifically, when I refer to pre-development costs, this is going to be a long list of costs from just getting the project started. We've got our market studies for feasibility, architects for the design of the buildings, the amenities, required environmental studies, deposits for land, securing the land, the tax credit applications, the list goes on and on. A developer could be quite extensive on that aspect. Another attraction that a nonprofit is going to have for a good for-profit entity is having that experience and knowing how it works. This is going to benefit in the application process, and particularly in some states like California, we even require that experience be there. But it's still it's very advantageous to have that experienced team to be able to work along with and making sure you're avoiding all the various pitfalls that certainly develop in the process here. And also making sure that they know how their projects are going to operate, whether they're going to make sure that they're structured properly, make sure that they properly cash flow and work as we budgeted. A nonprofit can also get the benefit of a mentorship arrangement. I don't know if that's necessarily the for-profit's intent, but the nonprofit can certainly learn from the for-profit, whether they have ambitions to do their own projects, but they may also just be looking to have a long-term relationship with that experienced developer.
And your experience is, if you have the smaller nonprofit that's joint venturing with a for-profit, as you mentioned, foundationally, as you just did a very good job describing all the various factors, it's really the experience quotient that for-profit will have to help the smaller nonprofit gain entry, if you will, or solidify their place in the affordable housing development space with, as you also noted, small meaning small with respect to their affordable housing presence, not small in terms of their relative size or other metrics. Now, a smaller nonprofit could also seek to get those same benefits from a larger nonprofit. And I think you were sharing with us in preparing that that's certainly true, but you don't see that as often as you see it, the smaller nonprofit working with the for-profit.
It much depends on the circumstances of what the relationships are. I mean, a nonprofit, again, it depends on the resources that the parties are bringing to the table. So again, for now looking at it, that was a focus on the small nonprofit. What are the reasons why you'd have a larger nonprofit kind of doing the same things? The large nonprofit, they're not driven for the same experience. They likely have experienced team. They have staffing. They have access to these fundings. So they're not probably as motivated to work with a smaller nonprofit, but it can. I would see that can also happen more in a mentoring relationship.
Yep.
For there, because the nonprofits, what is their purpose? However it takes to carry out their mission. If they can do it, great. If they can outsource that mission to still accomplish the same thing, I think nonprofits are often much more open to that. But so again, what is the motivation for the larger nonprofit to work with a for-profit developers? I think it's leveraging, being able to use that for-profit to further a mission. Their mission, they want to increase the amount and the type of housing supply. And they could do that by leveraging that for-profit entity, and also critically be able to help diversify some of the risks that are involved in that development process.
Right.
So they're not solely holding all that.
So thank you for those descriptions of the reasons why small nonprofits or larger nonprofits would want to be joint venturing with a for-profit. Now I wanted to revisit the tax risks. And I say revisit because in the prior episode you talked about the tax risks for nonprofit developers that joint venture the for-profit. And they're so significant, it was important that we cover them again, even though we're looking at it from the flip side. So please describe the two risks and then explain how to address them.
Yeah. So the first one is still maintaining material participation of the nonprofit entity. By statute, they've been given this opportunity to be tax exempt, and they can't abuse how they're operating in relationship. The concern here is making sure that they have, as specific terms, continuous and substantial participation in what they're developing. So this goes from the full process, from the construction through operations to the disposal or liquidation of the entity. The concern here is that if the partnership is poorly structured, you could increase the risk of private inurement between the for-profit and the nonprofit. And private inurement being the defined as benefits received from a nonprofit, received from a nonprofit to the for-profit in excess of the value that the for-profit is putting into it. So private inurement can result in some substantial penalties to participants.
And I guess ultimately loss of tax exemption.
that is really so. Yeah, so I don't want to make it too nuclear on the concept, but it's
Exactly.
it's an important aspect to the nonprofit does need to protect and watch carefully for.
And then the other risk was tax-exempt use property. Please revisit the tax-exempt use property issues and steps to avoid them and steps to ensure that you've taken the steps to avoid them.
Well, definitely tax-exempt use property can be a very confusing term to many people, and very confusing to implement and follow and make sure even accountants that we have to watch carefully on how it's being implemented. The concern that Congress had when this was created is that the issue is, well, you get a for-profit and a nonprofit together. If we give all the income to the nonprofit and all the cash and benefits to the for-profit, everybody comes away happy because there's no tax involved. Well, Congress didn't think that was a great idea, and I probably have to agree with them that, yeah, it seems to be a kind of an abusive situation. So the tax-exempt rules, tax-exempt use property rules, were created to slow down the depreciation, and so you can't accelerate the losses at the beginning, and then should do a shifting of income. So As long as everybody, both parties come in equally, then there's no issues here. But it's this shifting of income. So particularly with affordable housing, the investors in particular want that early accelerated depreciation, the bonus depreciation, the faster depreciable life. But the nonprofit is still seeking cash flow. They want majority of the cash flow, particularly at the tail end. They want to be able to have access to the sale proceeds or even the property itself. So we have that income shifting occurring, and that's creating the tax-exempt use property problem here is then that's not occurring. So how do we resolve that? That's resolved with what Congress has provided. And I'll like that a little bit. My nonprofit housing developers handbook it goes into much more detail of what the tax code has provided, creating what they term I would term as a blocker entity for the nonprofit organization. And so this is an LLC that elects to be treated as a taxable corporation that then is no longer subject to those tax-exempt property rules. So great for that benefit, but there are some risks that come to the nonprofit in the process.
So when I think of the blocker corp, I think of your standard structure where you have a nonprofit partner in a partnership, you have a for-profit investor, for-profit co-developer, also part of the partnership. This blocker corp, if you will, is basically this entity between the partnership interest and the nonprofit that ends up being this taxable subsidiary of the nonprofit. And from Congress's perspective, they're not as concerned with more rapid depreciation because the depreciation is only going to taxable entities, albeit one of the taxable entities is a subsidiary of a nonprofit. So maybe share a little bit more about how that works and who makes the election and the importance of a certain election and why it's important for the for-profit and the nonprofit for the election to be made at a timely basis.
Yeah, so let's first give it a name. It's commonly known as the 168H election after the tax code where it's located.
Yep.
We seem to name things that way. But the critical part here is the confusion that also comes is that it is that LLC entity that is making the election. It's not the partnership that is. You've got the other partners in that partnership are looking. It's like, I make sure everything is taken care of. They've formalized it in the partnership agreement, and that partnership agreement will state that election needs to be made. But there's nothing in there. You're not going to get the partnership tax return to say, oh yes, there it is. The election's in there. They're counting on the LLC entity filing a tax return and making sure that election is in there. And so there's a risk that miscommunication that it could simply be overlooked. And then so the critical part is timing now. It is extremely important to make sure this is timely made because to be effective, it needs to be in place before the property is being developed is placed in service. So because that's what's driving the depreciation, the depreciable life of those assets. So new projects maybe have a little cushion during the construction period, but if you, for example, you get acquire a occupied acquisition rehab project, you may have depreciation starting the day it was purchased, which won't give you much time to make sure that election is timely implemented. So what happens if you don't make that timely election?
Good question. Please answer.
So I see there's two potential painful outcomes that may result. First, you may be simply be in breach of the partnership agreement and be held liable for the economic impact to the other parties for not making that election. The main aspect there is that you're going to be subject to they're subject to the higher income taxes, to that loss of bonus depreciation and the delayed depreciation associated with that. And the second outcome of that alternative, though, is the attempt to correct the missed election. It may still be a costly process of getting a private letter from the IRS. So neither one are very desirable outcomes.
And if it's direct tax credit property, you don't get historic tax credits because it's tax use property, and as you wouldn't get bonus depreciation, there's a number of bad outcomes in terms of deferring or losing tax benefits. But you mentioned that the nonprofit would then likely be on the hook for the damages caused by that. But in the alternative, you had mentioned this process whereby you can apply to the IRS to get approval to make a a retroactive
Yes.
election in 30 seconds or less. Can you describe roughly what that involves?
It's a very complex process. There's a lot. You would think of just a simple one-page letter saying, "Hey, we made this mistake. Can you reverse it out?" But no, the IRS has a very complex process and charges fees,
Right.
specific fees for even to be able to go through that process. It was
Right. There's definitely as you know, there's a serious set of requirements that you have to satisfy to be eligible to get the approval of an extension of time to make the election. And have you had clients that came to you after they realized they didn't make the election, that came to you and said, you know, something, Lance, I guess I should have used you in the first place? Have you worked at nonprofits through that process yet, or even fortunate enough not to have?
I have. I just recently went through one that we went through the full private letter ruling.
Okay.
There was another case though, and again, it's important here. I think it's to understand the necessity of this. The second case I have, we looked at this to say, yes, you clearly missed the election, but then we looked at the details. There was no benefit in even having the election made. That the investor wasn't seeking any accelerated depreciation. They even wanted the longer depreciable life. And it's like, we can go through this process, but maybe you can get a waiver from the investor.
Got it.
And skip the whole thing. So that was a favorable outcome. The private letter ruling was not a favorable outcome. It was very costly to the client to go through the process. And not just the process of fees to the IRS, but the cost of going through all the paperwork
Right.
to be able to get there. So simple recommendation is to make sure that you understand upfront what you're getting into. And so I could note that a risk involved here with creating this taxable corporation is that now the nonprofit's still responsible for this entity for the life of its existence. So you got to pay attention to it, maintaining its books, making sure the tax filings are in there, and it's going to have potentially taxable income that, including distributions made to the nonprofit, are going to come through as unrelated business taxable income.
Yeah. Thank you. Thank you for that. And that's something that the nonprofit election, it's obviously something they need to be thinking about and be mindful of. So let's now.
I'm sorry. It's just going to point as bad as I might the sound might scare the nonprofits away. I think it's still a very effective tool. I know that just as a kitchen knife, it can be very valuable to a chef.
Right.
Careless use could be kind of painful. But similarly, the election here can greatly enhance the benefits of the partnership. The nonprofit just needs to understand what those are, when and when not to use this tool.
Yeah, that's exactly right. I mean, it's used commonly because it is a useful tool, but as you point out, you need to use it the right way and be aware of the implications of using it. So let's close with you talking about some of the challenges to a nonprofit when they're working with a for-profit.
So I think the issue, again, we kind of hinted at negotiating up front, making sure everything is openly discussed at the beginning of the phase, as you're still in the discussion phase of going into it, the deal. So we want to negotiate all these issues. So some key issues that we want to make sure: who is making the decisions? Which party is responsible for the different aspects of the decision process that's going to go through here? We've got some key elements of the developer fee, and who is going to get the developer fee? How is that going to be allocated between, we've got two developers now. They both want 100%, of course, but that's eventually going to have some type of sharing that needs to be involved in there. And as far as we're talking about allocations, there's also the operating cash flow from the project. We've got two parties that both are operating there, and we've got to determine what the cash flow operations should be, including the winding up of the relationship. At the end, you've got the potential for the nonprofit they're going to be seeking the ROFR, which is the right of first refusal of the property, to be able to purchase that. Typically it's the debt plus taxes or just be able to access that versus just being sold. Again, their motivation is to keep that housing supply in place. And if they control it, that helps them fulfill their mission. Another aspect is still making sure who's responsible for the guarantees during the project. Who got the construction loan, construction completion, and you even have the coverage of operating deficits, particularly during the early life of the project. So all of these things if they're discussed and memorialized, I heavily emphasize having that strong memo of understanding or MOU clear, so everybody is clear what the expectations are for the full life of the project, and so there's no big surprises standing.
No, I think your point about having a memorandum of understanding as the basis for the negotiating the various agreements and the like is pretty critical to make sure that as we enter into the relationship, that there's a good understanding of the various issues. And so the attorneys negotiate the various agreements, understand what the intent of the parties is. And then obviously when negotiating the agreements, new issues will arise, but foundationally having an MOU that is pretty detailed is of utmost importance.
Yeah, I mean, that's a common, when I go to different conferences and things, talk about the nonprofit developers, particularly that's a common things like they're talking about this winding up phase and they feel caught off guard because this is what they intended. And so, for whatever it is. And so, well, how is it documented?
Right.
So
thank you, Lance. I appreciate you coming back so quickly from your last appearance. And I mentioned I'll share Lance's contact information in today's show notes. But before we go, Lance, are there some additional resources you recommend our audience turn to beyond emailing you?
Yeah, I think we have some great resources out there. So first, definitely the LIHTC working group. If there's a group that tries to get into so many of these challenging issues that are confusing and trying to get some more clarity on how things should be done. We have our LIHTC conference coming up here in September at the 25th and 26th in Nashville. And of course, there's the latest edition of the Nonprofit Handbook, just came out earlier this year, and it's available on our website.
Great. Thank you for that. I will note that our LIHTC conference in September in Nashville, we're still hopeful that the expansion of the loan for the tax credit and lowering of the 50% test will make its way.
Yes.
It's actually made its way in, but that it'll stay in. And it looks like the Senate bill that just came out today expands or makes permanent some of the provisions in the House bill, but also makes some other adjustments to the House bill and the tax provisions. But we hope that does get enacted and signed into law. So when we're discussing the loan for the tax credit at our conference in Nashville, we'll be discussing the implementation of the additional 9% credits and the lowering of the 50% test. And that's obviously something that we will be talking about on our monthly loan for the tax credit working group calls. So I would also echo your note of that as a good tool or a good means of staying current on developments in the affordable housing space. So thank you, Lance. I appreciate your being on the podcast today. Please do stick around for our off mic section.
All right.
Before we go there, I do encourage every week our audience to consider subscribing to Tax Credit Tuesday, and not even just consider it, to subscribe to Tax Credit Tuesday on whatever platform you get your podcasts. And if you're watching on YouTube, please take a moment to like or comment on the video to help raise our visibility in the YouTube space. I also encourage you to share the podcast with your colleagues on the various topics that you think might be useful for them. And we do have a full archive of episodes available on our website at novoco.com. So now, Lance, we're back to our off mic section. And the regular members of our audience know that we use this space to give a shout out to others working in the tax credit community. Lance, who would you like to give a shout out to?
Well, last time I was to the nonprofit developers, and maybe that's a flip-flop, but I think it's worth definitely giving the for-profit developers. I think we have some great for-profit developers out there doing a lot of great stuff.
Great. Thank you for that. I appreciate the shout out. Yes, for-profit developers, we appreciate all that you're doing to provide affordable housing to millions of Americans. And hopefully with the passage of with the anticipation of the passage of the tax bill with the LIHTC expansions in it, there'll be a lot more tools in your toolbox, resources to be able to get more affordable housing developed. And with that, thank you again, Lance, for being on the podcast today.
You're welcome.
And to our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac & Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac & Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.